Mhm.
I can now, Milt. Thank you.
Okay, fine. Want to make certain you're in.
Paul, can you hear?
Yes.
Thank you.
We have one more visitor. We can start a meeting.
Just to make sure we can-
Tony, hopefully they gave you some good stuff to take.
They did, but I have some leftover too, though. So
First, I want to wish everybody a happy spring equinox.
Thank you.
Or do we offer sacrifices at midnight?
Oh,
Not it.
No, but it's even day and night now. We're half and half.
is that what today is? Today?
Uh-huh. Yeah,
Much like the voting populace, I take it.
we can look forward now to when the day is the longest day.
Yeah, I'm looking
I'm
forward to
just
that.
happy that days continue to get longer.
And the sun's out, yeah.
All righty, we will start a meeting unless the technology is all operative at this particular point. Okay, we're going to start the meeting. We have to have a roll call, which
Heather Finn,
Yes.
Paul Hamble,
here.
Captain Aaron Schaefer,
Here.
Sharik Mansouri,
Here.
Jody Patterson,
Here.
Tony Waskowitz.
here,
Thank you. Milton Wilkins,
I presume he's here, yes.
Henrietta Brown here, and Matt Livesey. I think is going to be joining us shortly,
Okay, fine.
virtually.
First item on the agenda is approval of the minutes for February 24th board meeting.
So move.
Second,
Jody was second. She beat Sharik to the
sorry.
Paul made the motion and Jody second. All those in favor? Any opposed? All right, wonderful. We're off to a great start. Let me scroll down here. Okay, request for benefits. We have civilian request first, retirement benefits.
There are 11 totals for civilians.
Yes, are there any controversies, issues we ought to be aware of?
No, sir.
Any discussion regarding the 11 recipients? I have a motion for approval.
So moved.
Pepe moved,
Second,
Jody second. Jody's not today, she's out. Okay, may I have a vote? All those in favor of approval of the civilian request for retirement benefits, say aye.
Aye.
Any opposed? Okay, police requests. We have 7 requests from the police for retirement, which is, they certainly deserve it, but I'm only sorry to see the police force go, anyone on the police force go, we need them. All right, any question, comment, controversy? I have a motion for approval.
Make a motion to approve.
Second. And Paul second. Aaron and then Paul. All in favor?
aye.
I
Any opposed? Application for death benefits, never pleasant. First are the civilian requests. You will note that there's one particular party with 3 beneficiaries, so it seems like there are more requests than there actually are. Any questions about that? Any, okay, may I have a motion for approval? So move.
Second.
All those in favor?
Aye.
Any opposed? Okay, police requests?
Make a motion to approve.
Second. Aaron and Paul, all those in favor?
I
Any opposed? Pass. All right, now we go to ACG. We have a full agenda of weighting matters, so let's move on.
Let's dive into it. Thank you. And everything, all these materials are in one packet. And so what we'd like to start with again. So first off, we'll continue our discussion from last month on strategic asset allocation. Again, it's very important for us. Asset allocation, more than anything else, drives success of our plan over time. And so every year, we do want to, with the board, confirm, set a strategic asset allocation So we'll have that discussion. We also, something we want to do every year, and the board has, we've talked about the last few months, active passive review. This idea of being active with investment managers or passive, where and why do we think it makes sense? So we'll talk about that. We did bring back, again, we were asked to look at potentially in our international portfolio. We hired Silchester 2 years ago-ish, a little bit less. We interviewed Causeway, and there's some discussion about, well, hey, should we bring Causeway back and potentially split that mandate? So we'll look at that and have that discussion. And then, of course, we have a performance update through February. So,
Make the best use of our time. Should we leave the performance update until last?
yes, I think so. That would make sense.
Okay, fine. Let's talk about strategic asset allocation.
And I just want to add to what Finney said, because I know we've had discussions last month and in the past about allocation of the portfolio. It's important to understand when we're talking about strategic asset allocation, we're talking about policy targets for long-term allocation. We're not necessarily talking about how we're positioned today. Your policy allows for some ranges around the targets so that we can balance back to targets.
Mhm. All right, take it away.
Awesome. And Becky, I know you're pulling it up on the screen, but in the first tab, the materials in front of you, page 5. So again, we look to sync up our strategic, Jake said, long-term asset allocation versus our goals. Again, what are our goals? And really first, couple things truly important. Our current actuary rate of return, 7.25%. This is what the actuary works with to determine what our funded status is, match these expected returns up with our contributions over time. As we all know, we don't hit 7.25% per year. This is why the actuary smooths these returns in their analysis, but over time, we want to hit this return. Over long-term horizon, very, very long-term horizon, right? This plan will continue to be around for many years. So how do we get that 7.25%? Well, first and foremost, we got to be there to participate in the up markets, right? We have to be invested in these return-seeking assets that'll add these higher returns above this, even above this 7.25% over time. But we also need to be wary and make sure to protect ourselves, at least in a relative way, during periods of volatility, these bumpy markets, right? We don't have a crystal ball. We can't predict everything. So we got to strike that balance of protecting our portfolio, but participate in the up markets. All of that while, again, the third thing that's very important, remaining liquidity in our portfolio. As a reminder, we pull out somewhere about $3 million per month to pay our beneficiaries from our portfolio. So we need to make sure we have that liquidity available. So as we think about where we sit today and what we'll evaluate from an asset allocation, strategic asset allocation standpoint, first and foremost, it's very important for us to be, and it's very, we think it's commendable that we are currently well diversified. In particular, when we mean that, the 3 big levers that we have in our portfolio: equities, these get in the return-seeking area of the portfolio, fixed income bonds, which really helps protect us, the ballast of the portfolio, provide that stability, during times of volatility, and then real assets, these physical assets that we own, certainly providing diversification. We want exposure to all 3 areas. We have exposure to all 3 areas. And we'll look at maybe tinkering that a little bit, but it's important that we have exposure to all of them. From a performance looking back standpoint, again, our goal is to hit 7.25%. We know this doesn't happen every single year, but we want to do this over time. If you look at our portfolio, as we ended 24, the 10 years trailing, while we outperformed our policy index, we didn't quite hit that 7.25% return. Right, and a lot of this has to do with, we'll talk about the last 10 years broadly in the markets are actually below their historical averages. So it's great we beat our policy index. We still want to keep up and hit that 7.25%. Now, I think that the next page highlights this pretty well, just how much returns fluctuate over time. So if you have to look at kind of this average 10-year return over the last decade, we are above our 7.25% return and above our policy index. So we're close. We're in line with kind of what we want to be. And looking forward, we've run kind of our analysis. We'll talk about that a little bit, our model, and I know we talked about it last month. But if we were to look at our current target asset allocation, looking forward over a 10-year, over a 20-year, again, we run a tremendous amount of analysis on this. This median expected return that we would have is above 7.25%. So we're in the ballpark. We've brought a lot of different various mixes to kind of look at as we can talk about how we want to adjust that.
All right.
The next page, which again, I do think is important, we've hit on this before,
Excuse me, page one,
page 6.
for Tony's benefit, so he keep track. All right,
And Tony, do you have the materials electronically?
I do. Thank you. Yep.
Almost there.
No, you're good. I didn't send it to him, so I'll make sure you have it. Page 6. So again, this is what I'm speaking to in terms of, returns over time and how they can fluctuate. So what you're looking at here is the 10-year return of our portfolio, net of fees, in blue, what our strategic policy index, our benchmark is in dark blue. And we kind of see, again, we want to hit the 7.25%. The end of 24, the 10-year annualized was below that, a little below 7%. A lot of this has to do with, as we'll talk about in a minute, over the last decade, for the most part, markets struggled, save U.S. large cap, which we'll hit on. But you can see this does tend to go in various regimes. These are the last 10 calendar years. What our return was, what our policy index is. If you average all these 10-year numbers, you get that bottom box at the right. So overall, kind of throughout the average of these 10-year decade, about 7.5%, certainly strong return above our policy index. But again, as pointed out, it does come in waves, right? The first part of this really because of 2008. Equity markets were down 42% peak to trough at one point. That lasts kind of longer in effects the next 10 years. As that rolled off, you can see we had a period of 4 or 5 years, really strong performance. I mean, multiple percent, even at 1.3.5% above our actuarial rate of return on a 10-year basis.
I want to make sure everybody understands, each point is an end of year looking backward 10 years. And I think if you look at that 2017 to 2018, nothing dramatically happened in 2018, except when you're looking back 10 years, 2008 is no longer included in that 10-year number.
Mhm.
So your 10-year number went from 6% to 9%.
Yep.
And between 21 and 22, something did happen, but that we had increasingly gone up. So the 10-year trailing return at the end of 21 was almost 11%. And from an actuarial standpoint, you're booking surplus when it's that much over your required return. In 2022, we saw equities go down by 18%, bonds go down by 13%, really as interest rates went up by 4.5% across the board. If we looked at our capital market assumptions at the end of 21, our 10-year forward expectations were significantly lower, projecting about a 6% return for this portfolio, the 50 percentile probability, because bond yields were at 1%, 1.5%, and equity valuations were really expensive. Today, as Finney will talk about in a minute, our capital market assumptions 10-year forward at the beginning of this year, a little bit lower than last year because equity valuations in the US went up. Bond yields actually came down a little bit, but relative to 2021, we're still in a much better place because yields are just significantly higher than they were really for the better part of the last decade, going back to 2008.
So again, kind of point on this slide again, just to highlight certainly the volatility of markets be even shorter periods of time, even 10-year return in the longevity of this plan is a relatively short period. And so as you can see, as you look at over the vast time horizon here, our portfolio is certainly in line with the returns that we were seeking, even if not every single endpoint is above that 7.25%.
Excuse me, let me ask, because I'm not clear on this. You've got up at the top, it says global equities. Is what this chart is only looking at the global equity part of the portfolio?
No.
Or are you talking about the entire portfolio?
The entire portfolio.
That's
So-
just highlighting what happened in 22, why your total portfolio return went from 10.7 to 7.3 on a trailing.
Okay,
When you move a year forward, now your 10-year return is 340 basis points lower than it was the prior year end.
now that I
That
understand.
year, global equities were down 18% and
Okay.
bonds were down 13%.
Right.
So page 7 just kind of expands upon then, okay, so how does all this impact our expected returns going forward? And what Jake just mentioned on, if you look at page 7, we've highlighted the major asset classes where we're invested, what the return was for these asset classes in 2024, the light blue line, the last 10 years in the dark blue, and then longer term, since inception of each individual benchmark in green. And what you see first and foremost, 2024 was a good year. We talked about this, we reviewed our performance. If you look at this light blue line compared to the dark blue line, it's higher in every period for every asset class, except for non-US developed and real estate. Meaning that the 2024 return for each asset class is better than its last 10-year return cumulative. So certainly 2024 was strong, which speaks to, as I'll mention in a minute, why our expected returns from this year going forward from last year are a little bit lower, because we had such a great return in 24. Now, the other aspect that I'll mention, if you look at the dark blue line relative to the green line, so the last 10-year returns versus longer periods, the dark blue line is below longer term in all the areas except US large cap. Meaning that actually the last decade for all these asset classes is a lower return than their historic long-term average. Except again for US large cap, which you talked a lot about, has really led the way. So actually it goes to speak a little bit to some of the recent as of 24 10-year returns being a little bit more muted than historically we would expect.
Mhm.
So all this brought together, you flip to page 8. And so these are our by asset class 10-year expected returns, again, for the asset classes where we're invested: US, international equity, private equity, fixed income, real estate, etc. So you can see we've put what our expected returns were each of the last few years. So as I just showed on this page, and as Jake just talked about, you can see relative from 24 to 25 down a little bit in terms of expected returns over the next decade. Why is that? Really because of how strong returns were in 2024. In particular, and also rates dropping a little bit on the fixed income side. You can see 2023, 2024, 2025, they're all kind of relatively in the same ballpark though, right? They typically don't change. 10-year expected returns don't change a tremendous amount year over year, except maybe when there's a big event, which there was in 2022. And so this is what we were talking about earlier. The 2022 expected returns are January 1st, 22. So again, going into 22, when our 10-year return was 10.5, as I just showed you, equity valuations were very high. We had, lower expected return going forward. We saw that big pullback both in equity prices, bond prices in 22, so that had an impact going forward. So ultimately, you can see relative to last year, we're slightly down, in line for the last couple of years. But even as importantly, as we look going forward, what's the relative differences going down the 2025 column? In other words, from an expected return, where do we see, various areas relative to each other which look attractive? And as you can see from an equity standpoint, particularly public equity, which is the first four, US large cap, US small cap, international developed, EM, you can actually see US large cap remains the least attractive, the lowest number of this group. Again, still positive as we expect going forward, but less attractive given really the high valuation, all the strong returns that we've talked about. Private equity, which we have in our portfolio, we continue to think is a return enhancer within our equity portfolio. And then the one thing I will mention, real estate is the one area in our portfolio relative to last year is actually slightly ticked up in terms of expected return, given what's going on in the market. So,
Phil, can you explain what's the difference between private equity and large and small cap equity?
sure. So large and small international emerging markets, these are all publicly traded equities, meaning you can go buy them on exchange, right? If in the US, we all can go do it. Yet you might have to get some approvals internationally, but we can just go buy Apple, whatever, on kind of the stock market right now. It's listed, anybody can buy it. That's what publicly traded means. Private equity, these are still companies, but no one can just go buy them, right? You have to, they're private partnerships, they're privately held, a lot by individual families or some just private corporations. So when they get transacted and someone can buy ownership in, it's a negotiated deal. And typically it's for a larger piece of the ownership than you would say if you were just to go buy an Apple stock. If you were to go buy Apple stock right now, you'd own like 0.0000% of Apple. If you were to,
Benefit of private equity for pension funds. Pension funds are large investors in private equity. It's because the asset class has a longer time horizon and it's illiquid. You can't get in or out. What you convert your dollars to a partnership for a 10-year period, but for that illiquidity, we would expect a return premium.
Okay.
And over time, we have seen private equity outperform public markets by 1.5% to 2% or more over time.
What would be like a specific private equity that we,
Well,
standard take in?
you're in a fund of funds, portfolio advisors, which you made a $60 million to in 2022. They're invested in probably 30 to 40 underlying partnerships. And then under that, there's 1,000 companies. These are from early stage technology, venture capital companies to some later stage turnaround, might be buying a public company and taking it private. It's a very diversified portfolio. It is something that it's been in your target allocation for some time, and you're still at about a half weight there. You made your first commitment in 2022. We're going to need to make future commitments to partnerships to get to that target weight.
Thanks.
Before you go further, why don't you mention several types of private equity deals?
So
Yeah, venture capital. Go ahead.
so you can think of private equity as basically the,
Just as examples.
just as the business cycle of a corporation, right? So venture capital is investing in startup companies. And so what a lot of people think about is these tech companies, right? Out in
Like to see
Silicon
down
Valley.
in T-Rex downtown.
yeah, probably further along than that. So, but today, I mean, there's public companies, Facebook, Meta, Pinterest is one that comes to mind more recently. I mean, these are public companies, but they started in as venture-backed companies by venture capitalists that create a fund that is invested in technologies. As you move out along the spectrum from venture to what we call seed, early, late stage venture. So think of that in terms of just the maturity of the companies. Then there is growth equity. So growth equity is companies that are either on the cusp of being public or maybe public companies that need to go private, need more capital. But they're still growing in the private markets. Then you move out further into the spectrum, what we would call buyout type strategies. This is going to be more, I think in terms of your public markets, more value oriented, but these could be family-owned businesses, generally not in the technology, but services, business services, industrials. They're mature companies that have been around for a while. And then the ownership, the family ownership or the small company ownership they need liquidity, they need to pass on to the next generation. So they're going to sell to a strategic buyer, and then they'll build that company up and sell it to somebody bigger. And then you get way further out on the spectrum to what's called special situations or distressed. This might be buying, again, public companies or private companies that are undergoing significant distress. So they could have a really bad balance sheet, or just, it might be a business that Hostess that went out of business, but there's a brand that somebody said that brand is good. I'll buy the brand and then I'll restart that business. That's special situations or distress. So it's investing along the entire spectrum of evolution of companies in the private markets.
Thank you.
Any other questions about the nature of private equity? Proceed, please.
So then just, I mean, so last thing, you see our assumptions here, and we'll build this on how the portfolio gets together. But again, thinking too, we want to get 7.25 at least over time. We have fixed income in the portfolio, but that in itself isn't going to get us there. Even real estate provides diversification, core real estate, still a little bit below that. So certainly this is where we kind of bring these equities in, these return seekers over time. They're going to help us, again, find this combination to get this 7.25%. Flipping to page 9 and talking about equities, we know this has been certainly a discussion we're going to have as we look forward at more of these potential mixes, but also that we've had the last few meetings about what's happened. So what page 9 highlights here, at the very top, it says MSCI Equity. This is the global public equity universe, the benchmark. And we've talked a lot about this. It is a market cap weighted index. What does that mean? All the stocks, the publicly traded stocks that are in there, their size in the index changes and varies based on their overall size relative to each other, right? So they don't all have the same equal weight in the index. It's based on their size in the economy. And that's simply taken by how many shares they have outstanding times their stock price. So Apple, one of the biggest companies in the world, will have a larger allocation in this index. What we're showing here is this breakout in percentages in the global public equity universe this is just the last 10 years, of US stocks in light blue, non-US stocks in dark blue. If you look at 10 years ago, in 2014, there were actually more from the size, market cap standpoint. It was basically 55%, a little over 50% non-US, less 49 to 45% US. That kind of hovered around that for a few years, and you guys can see the big break, really particularly the last few years. So we went from, if you were invested just passively globally from a market cap standpoint, you went from being 51, 52% non-US to today you're 2/3 US, 66-34. So this has been certainly a tremendous change and kind of this breakdown from a market cap standpoint of the universe of publicly traded companies, and certainly has an impact as we compare ourselves versus benchmark and versus peers and what they own. So
Is it correct or incorrect to say that Apple has a larger market cap than the stock exchange in Germany?
Apple, there are several statistics out there where if you were to look at some of these individual companies, particularly this Mag 7, what you would compare them to, they're bigger than, the overall economy.
They made up
Various
20% of the equity at the end of the year.
Yeah.
Mag 7.
There's the next 7 largest countries made up 20%.
It just gives you an idea for the non-professionals here, because the idea of how large U.S. growth companies have really changed the nature of the relative
Of the
weight.
users. Yep.
Of domestic versus international stock. You have Apple and NVIDIA, Microsoft, et cetera. Not only have they changed their relative weight within the United States between large cap and small cap based on market capitalization, but also between domestic equities versus international equities. A lot of that is driven by 20 companies.
Yeah. So that's driven a lot, certainly that weight in this global market cap. And so how does that compare to what we own, basically? And that's what's on the next page, page 10. And so if you were to look in the top right, what you're looking at here is our public equity allocation broken down by US, non-US versus that equity I just showed you, 66-34. So equities there in dark blue, 66% in US companies, 34 in non-US. Are publicly traded, so the 4 US large, small, developed EM, were 55-45. So it's actually significantly 11
target basis.
This is all on a target basis, correct? For our target, 11% less from a US standpoint than the global benchmark. Now, what we think is more the appropriate way to look at it is if you look to the left there in the top left, what we're including here is private equity. So Paul, you just kind of asked about private equity again. So these are companies that we're invested with, really pretty much all in the US. It's just a different type of structure, type of vehicle that we invested. But from an equity investment standpoint, we want to consider private equity. So when you include our target to private equity in the grand scheme of our equity exposure, we're much closer to a 60-40. It comes out at 59-41, 59 US, 41 non-US. And so still lower in US relative to the recent upsurge in equity, but actually relatively much closer to what more historical average has been over the particularly the last 10 years. So what I wanted to highlight this and keep this in mind, because as we look at our portfolio mixes, we know our breakdown in targets with equity is a big aspect of it. We want to keep in mind, this is our current starting point where we are relative to MSCI equity. Make sense? Page 11, Tony, this was a specific request you had made to ask about other real assets besides real estate in the portfolio we should consider. The shorter answer is we're very comfortable just with real estate in the two flavors that we have: core real estate, kind of direct ownership, pretty stable properties, and then value add, opportunistic, which much more development areas there, which particularly include things like self-storage, certainly life science facilities. The other areas where we would look at, certainly commodities in the real asset standpoint, we've included on the far right what our expected return and volatilities for these are. Commodities can, in short periods of time, add quite a bit of return, but can be quite volatile. Infrastructure and green, this is an area, and you particularly mentioned digital infrastructure. This is an area that's certainly getting more popular, more attention. It really, at least from our standpoint, is somewhat still in the early phases from an institutional investment standpoint. We wouldn't necessarily want to carve out a full exposure there. It could fit in some of these funds with a diversified infrastructure, but ultimately you look at their expected return volatility very similar to a core real estate. So our approach would really be to break in between core and value add. And in particular, we currently have a 15% target to real estate. But something we'd recommend, and we're going to talk about, is actually dropping closer to 10. So with just 10% real estate, our thought would be to just continue with core and value add real estate. So you would ask us, Tony, for a really quick summary. I'm happy to expand more on it, but wanted to make sure we address that for you.
Yeah, thanks for bringing this forward, Vinny, and I appreciate the slide and your explanation on it. And I think you hit the key to why I was asking this, that if we remained at a 15% target allocation, would there be ways that we can increase the diversification within that 15%? Because that's a pretty high weighting. And if we can't, then should we contemplate us lower weighting? And it sounds like that's kind of where you're headed. So thanks for this.
The other challenges where we think commodities is really challenging, and we're not in favor of commodities in a strategic allocation, because you make it and it's so volatile. It's good in very short periods of time, but you have to be able to get in and out. On the real asset side, look to diversify within real estate, whether it's infrastructure or other value add, more niche strategies. Those tend to be in closed-end vehicles like private equity, which I think are also somewhat challenging for this board to get into based on the current governance and approval process. So.
Great points, Jason. Thanks.
Thanks, Tony. So to get into actual projected returns, page 12. So what you're seeing here, this first column, this is our current target asset allocation, broken out by those three big levers we've talked about: fixed income, equity, real assets, where they currently are. And again, the overall diversification we think is great. Based on our current market assumptions, if you go down here to this, we run this both at a 10-year level and then also at a 20-year level. And again, what we're showing, we run this through a Monte Carlo analysis, several thousand different potential trials. And what it highlights here is our median projected outcome. And we rank them from worst to best. So what we're saying, we think there's a 50% or more probability over a 10-year period that our target portfolio gets 7.35%. Over the 20 years, you can see that hops down a little bit. That number moves up over time. We do think our exposure to the risk assets overall over a longer period of time helps. That'll get close to an 8.2 median expected return over a 20-year period. What you can see here below median return is standard deviation. Standard deviation we talked about. This is a measure of volatility, and it's a quantitative measure, very statistical in nature. But really, just think about it: the higher the number, the more volatile you are. The higher the highs, the lower the lows. We show a Sharpe, which is a measure of efficiency, and then this 10th percentile return really is just to give a sense of, again, we do this expected return over periods of time, rank them out. If you were to get kind of this 10th percentile on the low end, what a return could be in any one year.
Again, for the benefit of the non-professionals here, can you define standard deviation as well as Sharpe ratio?
Standard deviation, so again, it is a measure of variance around this target median return, the 7.35%. So you can think about it as, again, the larger the number in any one year, the particular swings from, above or below that. Now there's different confidence intervals then you can use with standard deviation that really gets into statistics that I won't bore you with. But really this, and we've got a visual on that highlights some of the variances that we have. But just think of that as kind of plus or minus.
The next couple of pages, we're running all Monte Carlo simulation, so it shows the distribution of outcomes. The higher the standard deviation, the wider the distribution of outcomes in any one year are going to be. And just that 10-year median and the 20-year, that is looking out over a 10-year period or a 20-year period. The 10th percentile return we're showing here, that's any one year, not necessarily next year, but any one year. And what you'll see is the range of outcomes in any one year is really wide, but over time, that range of outcomes narrows.
So for a lack of better measure, standard deviation is used for risk in terms of the volatility of the asset. So the higher the number, you'd expect more volatility in that asset class.
Yeah, and the usefulness of it here is really as we're comparing mix to mix. And really that's what you asked about the Sharpe ratio. That's what the Sharpe ratio is telling us. It's a Sharpe ratio is a measure of efficiency, risk adjusted returns. So when we see your target is 7.35 with a standard deviation of 11.84, the Sharpe ratio is 0.46. So you look at the next alternative, the median return goes up by 7 basis points. You said, well, is that good? I don't know. Is that good or bad? Volatility goes up by 22 basis points. The Sharpe ratio stays the same. So it's just as efficient. So it's comparable, if you will, from an efficiency standpoint.
Basically, so much return you get for unit of risk.
But it's useful in this exercise to compare relative efficiency of alternative mixes.
So all that said, so we've kind of explained how we evaluate the portfolios, what goes into our assumptions. So we've run a couple different things here that I'll take you through. But this page 12, we have our target portfolio. Again, you see we put a box around this 15% real estate. And that stays constant if the other three are various portfolios we can do. We've talked a lot about the mix of equity in our portfolio, US versus international. So we wanted to show on this page, we're keeping the big levers the same. We still have a 63% target to equity. As a reminder, we're currently 59-41, our target to US international. What would we be if we changed that to 50-50? 50, the first number being the US, right? So 50-50, they're equally split. The second option, 55-45, 55 US, 45 international. We're currently 59-41, which is basically 60-40. Or moving up to 65 US, 35 international, which is closer to what currently the equity rate is. And what you can see, keeping real estate the same, there's not a tremendous amount of difference in terms of expected return throughout the portfolio. There's really, and we'll kind of go this, there's not really a tremendous.
Where are you now, Ben?
We're on page 12.
Just across the board.
Just across the board. So you can see what going from the target to 50-50, so that's a drop. And we've done this in kind of in red and green, so you can kind of help see where we add and where we subtract to come up with these numbers. Dropping from US, adding to international actually helps out from a return standpoint a little bit over the time period, but it also increases that standard deviation, increases that volatility.
And it increases the downside. 10 percentile returns a little bit worse.
But even kind of with this, and a median return of 7.35 compared to 7.42 to 7.36 to 7.33. Again, these are estimates. I can pretty much guarantee you there's not going to be any of these four numbers 10 years, right? They kind of help give us a sense of where things are, but keeping real estate constant and just changing the mix within our equities ultimately, they are all kind of right in the same ballpark from an expected return standpoint. So flipping to page 13, it's a very similar process, except what we do here is we take 5% from real estate, you can see it's highlighted, and we give that to our fixed income portfolio. So increase fixed income, drop real estate down to 10%. And then you can see we take this same approach. We have our target, which is 59-41. We show 60-40, which is basically how we're allocated, but again, has less in real estate, more in fixed income. And then we show this various equity breakdowns, again, US, international, across the board. And really what you can see from a return standpoint, a much more significant change versus target than the previous page, right? Because you're moving one of the bigger levers. You're moving real estate to fixed income, and really what you're doing across the board is dropping returns about 10 basis points. And you're keeping volatility for the most part in line. Sometimes it's dropping, sometimes it's moving up a little bit. But I think where everyone really kind of wants to focus is the next page, page 14, where again, we're removing 5% from real estate, but this time we're adding it to our equity portfolio. So you can see our target to real estate currently now is 15. That drops from 15 to 10. And our overall target to equity, which is currently at 63, moves up to 68. Page 14. And then we do the same exercises. First, if we had a 60 US, 40 international breakdown in our equity portfolio with only 10% real estate, you can see that keeps our expected return about the same, volatility somewhat in line, but you can see ultimately the Sharpe ratio drops a little bit. And then you can see the next two lines, 50-50, 55-45. In both instances, we're really lowering our target to US equity relative to in moving up international equity. In both instances, it moves up our return, but also moves up our volatility. Lastly, this last one, 65-35, this would be the one instances where we actually increase our exposure to US equity in our target, reducing international relative to what we currently have. It actually, again, given because of where our assumptions are for US, particularly large cap, drops our expected return. But all three of these are still certainly very much.
With 65-35 is consistent with the overall equity.
Yes, it's much similar, right?
That's not a compelling factor. I just want to
Yeah.
that it's
Right.
consistent with how equity is distributed.
Yeah. And so ultimately, and we have more stats and everything to go through, and certainly we will, but pages 15, 16, and 17 kind of highlight these ranges, and we're talking about volatility. But ultimately we are in agreement that adding, moving, from the target, 5% from real estate to equities certainly makes sense for our portfolio as we look over the next decade. Our current breakdown of 60-40, 60 US, 40 international, we still remain comfortable with. We like it is an underweight, as Milt just mentioned, relative to the equity in terms of US international, but also given the last decade, the strong performance, particularly in the US large cap, we are comfortable having that relatively slight underweight to US relative to equity.
It's an overweight relative to the average over the last 10 years, because the average has been about 55-45. Right now, it's 66-34. So having that 60% US equity is over that. I do think the ranges are important, and not just focusing on this number for everybody on the board. When you think about your required return, that 7.25%, part of this exercise is evaluating, is that reasonable? It really, as you see, the differences don't move things around too much. If you look at page
17
or 18 or so does 20, really, because that's where we're focusing. That 7.25%, if we go out 10 years, your current policy, what this is saying, that gray line that's marked, your current policy has a 50% probability of being 7.25% or higher. So I know this is a discussion you're not having today, but this is part of that asset allocation discussion, understanding, is that discount rate a reasonable one? And, you know, we want it to be 50% or greater, and it is, on a 10-year basis. On a 20-year basis, that jumps up to 63 or 64%. Moving that, the targets up, reducing real estate a little bit and adding to equities, that improves the probability on a 10-year basis. So really, objectives, we presume objectives aren't changing. There's still a long-term time horizon in this portfolio. Still have at least a 7.25% return hurdle that you're trying to meet. Want to participate in up markets and protecting down markets. So it's not going to lead us to make recommendations to major swings in the strategic policy application. Some slight tweaks on real assets and equities we do think is prudent, and then looking at just the targets to US, non-US. Where we are today, actual allocation is about where this,
What page are you on now?
well, page 14, the bump, the lowering real estate from 15 to 10. And that 60-40 mix, that's about where we are today. We're a little bit overweight. We're at 12% real estate. We're underweight the 15. We're slightly overweight 10. Large cap is about 23, and that's because private equity is at 3.5, I think. We're underweight that target to private equity as we're moving toward that.
So yeah, if you were to look page 14, the 60-40, I mean, this would ultimately be our recommendation for our strategic asset allocation. Those red and green highlight what those changes to the targets are. Dropping 5 from real estate and really adding that pretty much spread out across the board, almost pro rata to how we currently are from a target standpoint, across the equities. And, you know, some of the, as Jake mentioned, this is not too different from how the actual allocation of our portfolio is right now. And also, I think a big thing that will continue to, that gets a lot of attention that we talk about is within equities, the weight of equity, which is 66-34. Would be 60-40. So we would have a little bit less US, a little bit more international relative to the broad investable universe. That's how we have been. That's how we are comfortable with, given where current valuations are. We don't think it's a drastic underweight, but we do think, you know, is actually, as Jake was saying, is closer to more to longer term averages from a valuation standpoint where our assumptions are. I think it makes sense.
Why did you not consider increasing private equity from 6.25% to 10?
We would. I mean, we think for a pension plan of this size with your time horizon, that is a 10% allocation to private equity is certainly reasonable. But modeling that when you're at 3,
Yeah, we're
doesn't make any sense.
the actual today is 3%. Is that what you're telling me?
Yeah, it's
It's about
The actual.
around 4%.
it just takes so long to get there.
Get there.
Right. So, I mean, we could show that, and that would improve. Having a little bit more private equity in lieu of other public equities is going to improve things. But it's just, we can show you that. Getting there is the challenge, as you know. I mean, we think we can get there, but it's going to require, we need to make another commitment this year, probably a similar amount as we did in 2022.
Well, would we get there any faster if we use an additional firm instead of just portfolio advisors, which I've been recommending to clients since 2004. So I'm not prejudiced against
Yeah, I don't think
portfolio
other
advisors, but
I mean, so portfolio, we're using a fund of funds approach. So
Yeah.
this is very diversified in multiple funds.
Yeah.
Just having another fund, and you
because
can't.
we're getting
do
the
direct
multiplicity
funds.
of funds underneath
Right.
anyway.
So-
Points taken.
And with portfolio advisors, I think we elected the the standard allocation. So there is a component of that that's in secondaries and co-invest, and not to complicate this discussion about asset allocation with private equity, but secondaries is buying more seasoned investments that were made in earlier years, so the money gets to work a little bit sooner. And co-investments is investing directly into companies alongside of the underlying funds that they're investing in. So it's reducing fees and getting money to work a little bit quicker. But still at that pace, you made a $60 million commitment in May of 2022. They've called 35 million to date, meaning that's how much has been invested in effectively 3 years. And there's 25.1 million in unfunded commitment, which isn't unusual. That's to be expected. You'll never reach 60 million in that fund. This will probably cap out on the current value of that 35 million that's been invested is about 38 million, and you've gotten about 500,000 back. We would expect that to cap out, maybe at 45, 80, 50, because they're gonna start sending money back.
This we hope.
Right.
It's a
Which
milk.
has typically been the pattern. By the way, before we get off the point, this is a technicality. Did we elect to be able to do co-investing?
Yes, it's part of it.
Can you check and see whether or not we are technically or legally allowed to co-invest?
You're invested in a fund.
The fund's doing it.
It's the fund. You're invested in a commingled fund.
So we're not doing it directly?
No.
Okay, still through a third party.
Yes. In the fund. You
Oh,
own units
Portfolio Advisors is directly
in
investing.
their fund. Yes. So you own units of Portfolio Advisors,
Fine.
Private Equity Fund 11.
But Milt, as our actual exposure to private equity gets closer to this 6.25 target, I would expect us to look at bumping that up at that point.
Is Portfolio Advisors the only company that does this?
No.
To Milt's point about if it's gonna take that long to get it invested, should we add another firm?
Well, it's a fund. So we like Portfolio Advisors and what they do in a fund of funds space. It's diversified. They have access to very high quality partnerships, the ability to somewhat select how you're allocating across primary funds, venture buyout, secondary and co-invest is somewhat unique.
So nobody else is a fund of funds manager.
So there are a lot of other fund portfolio advisors, how they do it in this flexible approach and from a pricing standpoint, as cheap as they are relative, they're a very attractive option. There are other fund managers that do that. We haven't found many that hit both those targets and have the performance.
There
But really,
are many fund.
there are many fund
vehicles.
but really,
This happens to be one of the lower cost ones.
so the difference is not so much how many funds you pick to get closer to actually investing, it's how many dollars you commit.
And how frequently.
Right. And so, in other words, and this becomes less about an individual manager discussion, the dollars you commit, and more about the timing. Because private equity, because it is closed ended, they start calling capital over a certain period of time
Right.
and start realizing that we want to spread when we commit out as much as diversification of anything else. And so it really becomes the dollars that we commit in 25, and you can choose to do that all with one manager or two managers, but just that in itself.
But it would be we would recommend, right now, if you're asking us, would we recommend Portfolio Advisors? Yes, we would recommend another commitment to Portfolio Advisors new fund. It's different than the one you're in.
Okay, so it's not a call on it's not the other 35 million that's gonna be called on the original 60
Well, it
million.
will be, that will be called, but they're in market with a new fund.
Okay,
Now, there are probably 3 funds beyond the one you're in
okay,
that is putting money to work in 25, 26, 27.
got it.
Okay. Other points you want to make?
No, I mean, I think
So your recommendations stay where we are.
well, our recommendation is to move the target Our recommendation is for the 60/40 on
First of
page
all,
14.
it's 60/40 on equity, it's what it is, right?
Yes,
Domestic and international.
Our
But the
recommendation
recommendation is also to go down to 10% on real estate
for the target.
target.
as a target. We're approximately 12 or 13
Well-
right now anyway. And how we get to 10 is basically going to be organic as we get money back from our requests for repatriation. of
Look at
funds.
page 14. Our recommendation is the second column, 60/40. And the recommendation is simply to modify the targets in your investment policy statement to what's reflected there. We're not talking about moving any money right now. So, and that's effectively just reducing the target to real estate by 5 and adding to the equities.
And my discomfort, which I've articulated in the past, is that if we had gone back 10 years and projected forward, when I left Mercer in 2014, which was about 10 years ago, the projections we had for international equities have not been hit. Or the projections we had for domestic equities were just were far too low. International was perhaps too high, and domestic was far too low. And I'm just very uncomfortable with international equities at 40%. And it's a judgment call. It doesn't cost us much in projected return to go from 60/40 to 65/35. Doesn't cost us hardly anything given your projections. I just have a discomfort with international equities, but that is a personal judgment. Sharik has a discomfort with increasing domestic equities, which I'd like for you to speak to as well. But and other members of the board may have other discomforts. So now because it doesn't appear that it changes the expected return a great deal. It doesn't even appear that it changes the expected standard deviation a great deal.
It slightly increases the risk because real estate has lower volatility than equities, is really what's happening.
Yeah, well, we're going down on real estate regardless. So it's only a matter of where we put the equity and in what form.
And I'll sound like a broken record. We're talking policy targets, not actual. We're gonna have a different discussion of where we want to be today.
Yeah.
That, if board members want to be tactical, that's certainly, you have some flexibility within your investment policy to be over or underweight a target by 20%.
Okay, but if we don't agree upon the target, we're never,
Right.
we won't have any discipline. It'll always be one person's opinion versus another person's opinion. We need to have a standard by which we can gauge our collective or individual judgments as to how we ought to proceed on a year-to-year basis. Now, I'd like to open up to board members if they have any questions on our preferences on asset allocation. Assuming we're going to go from 15 to 10 organically, we're about 12 now. Let's assume that we're going to get down to 10. In terms of relative weight between domestic and international equities, and equities including private equity, how do you feel? Because I have only one vote.
When might we decide to inject more money into private equity? When would that decision become part of this process?
So I think, Paul, we were to, what we bring back later this year is a recommended committing new dollars to private equity. And again, that takes time to wind down. So here you have,
And Paul, we haven't called all the private equity. money
Right, so-
that we've committed anyway.
it's in the fourth tab, Paul, but if you go to page 43, I think just as helps with this visual. So if you get there. So as Jake said, 3-ish years ago, we made a commitment to portfolio advisors for 60 million. And what that means is we're basically legally committing when to send them $60 million over a period of time. And that period of time is, 4 or 5 years. Of the 60 million, they've only taken from us 35. So the rest of it's been invested in our portfolio. So we still owe them about 25 million that, as Jake said, some of this ultimately won't be called, but the bulk of it will be called in the next 2-3 years.
So when would we do this? We think we should come back, we could come back next month or sometime this year.
Yeah.
With a review of the private equity portfolio and what we call a pacing plan, which is our projections or estimates of how much we should be committing every year to reach that 6.25% in a reasonable time frame without getting too far over our skis, if you will. We don't, we make assumptions about the existing portfolio, how that's gonna call money down the next few years, as well as how it's going to send money back to you.
Yeah.
And then what we have to commit to get to that target, without getting to, if the equity markets, if the public markets sell off by 20%, we don't wanna have, denominator changes and then 6.25% is a smaller number, and we're shooting for, a $60 million number, and now it's less than that. But I would anticipate easily we could make another $30 to $50 million commitment to another fund of funds because the pace of that being called is slow. So,
Typically, it would be exhausted in year 4 or year 5.
well, not in a fund of funds, because the fund of funds is committing to underlying partnerships that are raised
Now, it's that
year
can
0,
spend
1,
out.
2, 3, 4, 5. So it's a little bit.
If we're a direct venture,
Yes.
venture capital firm or private equity firm, then it would be exhausted.
little bit
You would probably have everything called by the end of year 4. Given the history.
Right, this one's gonna be, this will be a little bit longer.
So ultimately, Paul, I wouldn't expect us to get up to 6.25% of our portfolio of private equity. We're still a couple of years away from that. And then, but as we get closer to that, we can, from our target standpoint, it makes sense to adjust and increase that. if we'd like.
And is our commitment of 6.25% to private equity, changing that would be a decision we would make, what, after we see what it pans out with?
So the modeling presumes that that's how you're invested when it's projecting out these numbers. So we don't want to just put a higher number in private equity, knowing that it's not realistic for you to be able to get to that
I see.
number for several years.
Mhm.
So it would be the output would be suggesting that you're 10% in private equity.
For the whole 10-year period.
Right. And we're just not.
Mhm.
Sharif, you want to speak to your thought to the proposition on relative weight between domestic and international equities?
I think I've already spoken many meetings that I think rather than slice and dice numbers of historic performance, I think we need to look at it at a macro level as to why we are here. And, we've printed from 1 trillion to 40 trillion now in the last 2 decades, which has come into equity performance, which has gone to other countries in terms of performance and all that stuff. So, when we are patting ourselves in the back in terms of achieving 7% return, I think we should be clear about what the backdrop has been. And I'm sure we can keep printing to some point, but valuations as a result of that printing have been hitting the higher levels here in the US. With that backdrop, I'd be more inclined towards valuations in the international market rather than here. And
Now, again, that's what relative valuation has told us for the last 10 years. It hasn't worked out. You'll not have that conversation. So I just want everybody to be clear.
so
The
okay.
numbers will tell us that. Numbers tell us that. It
So-
never happened.
So you have to basically, I think, sift through that and see why that happened,
Yeah.
the money printing that happened here, the COVID that came in the middle, the relative currencies that come into play and the issues Europe has had and all that stuff. And then you got to say, is that going to happen for the next 10 years, as we said this? My opinion would be no. I think the dollar is set for some kind of a correction. And if that happens, then international performance will exceed the US performance, and you will not have the experience you've had in the last 10 years in the next 10 years. And we are more concerned about the next 10 years rather than the last 10 years. We already have the last 10 years, right? So looking at the last 10 years may not help us. It gives us a experience,
Yes.
right? And we decide on experiences in our life. A lot of decisions we make, but I think what we need to see is what's going on here in terms of currencies. When you talk about international and domestic, we have, what are we thinking about inflation? What are we thinking about, a lot of these things when you talk about real assets. Given the valuations here, and I understand they are a little bit skewed in the large cap area. If the decision at this point is to reduce international, which is what I'm hearing, I don't know if I would, if that would be my opinion.
I take it as not your opinion.
Correct.
Kevin?
And
I'm afraid the comment I'm about to make is going to sound political. It's really intended to be factual of what I've observed since January, which is that the way we assess things for the last 10 years is not necessarily the way we should assess things and count on them for the next 10 years. Based on a short period of time of current experience. And so that gives me pause in terms of the domestic. I would probably think more about raising the international. I think some of the outcomes of what's happened are in terms of tariffs, in terms of onshoring everything to the United States and how Europe is responding to that. Obviously, we can't predict any of those things, but we can extrapolate. And in doing that, I'm more prone to say, to look at making the increase in international.
Well, are you saying increase international? We're at 60-40 now. Are you saying going from 40 to
No,
50
but
or
to take
leave
the
it at-
5%
just leave it where it
and
is?
put it, yes, in international as opposed to putting in,
Okay, so remain at 60-40.
Well, and that's what we're proposing.
yeah.
Yeah.
No, and
And she's doing it for additional reasons
I agree with
beyond the
that.
ones she mentioned.
Yeah, I mean, I don't think
Things are a little bit,
that counting on the world looking the same 10 years from now as it did 10 years ago, and using that as a barometer is, I think at this moment, a fool's errand.
even next week for that matter.
Well,
Well,
What we're seeing right now, politically and economically, is to some degree almost unprecedented in its disrupting effects. But I also wonder if our national economy isn't still so powerful compared to everything else in the world that we still shouldn't just keep our faith in the course we've already gone down and stick where we are. 60-40.
that's
Does that make sense?
your
Yeah.
answer as well.
hang on, you were proposing going down 5%, just to be clear. So just to take a step back here. What Milt is saying is go 65-35. I was no, stay. If anything, I would like to increase a couple of percent and so on. So it started with, should we go down 5%? I was nay on that. So just to be clear
Okay.
where we are.
Okay, Tony?
Yeah, thanks, Mel. I'm very comfortable with the proposed allocation, specifically the reduction in real estate. And as it relates to the US, non-US, I probably am a little bit more on the fence of that. I don't think that the allocations are that big of a difference, the 60-40, 65-35. So I'd probably be comfortable with either, honestly. And I think when I think about these kinds of conversations where I get tripped up a little bit or where I think it's difficult to arbitrate a final decision is these policy targets are intended to be viewed over very long periods of time, kind of 10 plus years. And we're talking about a set of circumstances, investment circumstances that I think are very real, very substantial, but they're likely to be kind of short-term conditions, short-term being maybe the next 1 to 3 years. And as we work through those, kind of year 4, 5, and 6 of this 10-year period is probably going to be a whole different set of circumstances, and we don't know what they're going to be. So I'm looking at the strategic allocation, thinking through the long term, and trying to kind of look through a little bit of what's in front of us right this second, because it's likely to change over that 10-year period. So long way of saying, I'm very comfortable with the proposed allocation and very specifically the reduction of the real estate from 15 to 10. And a little more indifferent or agnostic to the US, non-US split.
I would concur with that, especially with the reduction from 15 to 10 in real estate. That wasn't.
In other words, forecasting is very difficult, particularly when it's about the future. So,
Yeah, that's the best way to say it, Milt. Yeah. And
please.
the one
Okay. Oh, go ahead. If you have something else?
Well, it's just on the edges. I totally appreciate Jason's point about the fact that the private equity allocation, that if we try to model 10%, it's almost becomes noisy because it would be 6, 7, 8, 9 years before we could ever even really prudently achieve that level. But there is something, and maybe I just asked Jason and Finney to react to this. Would it help ACG to know that potentially the board would be supportive of this continual increase of private equity? And is that a data point that would be good to know today, or we could just defer that conversation a year or two and it really wouldn't change anything? In other words, setting a target allocation, even though we all know that it would be a many year achievement of those target allocations, would it still be helpful to know that the eventual end game looks closer to 10 than it does to, say, 6? I'm rounding, but you get the idea.
I think we can incorporate that into like alternative pacing plans, Tony.
Mhm.
We could run one pacing plan targeting getting to 6.25% in, let's say, 3 to 4 years.
Yep.
That's going to be, a number that needs to be put to work the next 2 to 3 years in commitments. We could run an alternative pacing plan where we say we want to get to 10%, and that's going to be a different number. And then the board has to decide, are you comfortable at the ultimate commitment, making a commitment instead of 50 million, 80 million over 2 years, whatever that.
Well, I guess I was kind of saying a little something like I'd be comfortable with a 6% target over the next, say, 3 to 4 years, but thinking ahead, thinking that we don't want to stop at 6, we want to keep going to closer to 10. Yeah.
That's why I'm suggesting an alternative plan that just show what we need to get to do that.
Oh, I see what you're saying. Okay. Yep. Because I know liquidity management is the other side of that whole decision.
It is, but for a pension plan of this size, where your portfolio is very liquid.
Yeah.
A 10% allocation to private equity and a 10% allocation to real estate, which is less liquid. It's not completely illiquid, except when it is.
Yeah.
You have more than enough liquidity to meet your ongoing needs.
Yeah, that's really well said, Jason. I was actually um, thinking just about the fact that we will have the $3 million monthly pension payouts and, you know, I'm making up the number, but potentially like $90 million of unfunded commitments if we make a second private equity commitment. I'm totally rounding, so I'm not trying to anchor to a specific number, but it would be, that's almost 10% of the portfolio. So could we continue to, we would basically have funded liabilities to include both monthly pension payments of, again, $3 million plus private equity commitments. And I would just want to make sure that we could manage that liquidity transition effectively and prudently and not ever become a forced seller in a down market to satisfy those obligations.
No, that would certainly be taken into consideration, Tony, I mean, especially on both the US and, international. While international might not be daily liquid, it's at least monthly, and we can, get enough advance to control that. And then that's why we have the ballast of fixed income in the portfolio, which we can always access at any time.
Yep.
Yeah, I mean, that what potential draws would be and the liquidity of the portfolio, all that would be considered.
Okay, great.
Right. Tony, I'm gonna go to Aaron now.
I'm kind of similar thoughts as Tony and Paul on this. I guess my only thought is there investing less in real estate? Is there any concern with maybe more of a return to work,
Maybe more what?
more of a return to work in the offices? Does that have an impact on our decrease in real estate investment?
It doesn't to me, but,
I mean, our capital market.
we have to see it
To
first.
be
but
clear,
that's-
our capital market, not, what Tony said is spot on. We're looking long-term. We can't think about immediate. But our capital market, intermediate term capital market assumptions do reflect more what's gone on the last few years in terms of valuation and yields. So our international is actually up a little bit. I mean, it's down, but it's above large cap now. Real estate is the one asset class from last year to this year that went up. And that's because valuations have come down so much. Cap rates, which is the income being, the percentage of income being produced from real estate, that has gone up. Hasn't really moved, but it's because valuations have come down, you're getting a bigger yield. And so our 10-year forward-looking return assumption for real estate is up slightly from last year. I think it's 6.5, 6.8.
Okay, Jody?
I'm in agreement on moving the 5% away from the real estate. I'm on the fence about international versus US, probably leaning towards no change. I don't, from the long-term standpoint, I'm not interested in increasing the portion that goes to international versus US, and I'm hesitant to make any change with all the information we have now. I think is very short-term and we don't know what's gonna happen. And I kind of like our allocations where they are, with the exception of moving some out of fixed asset, out of real estate.
Okay. So we've been around the table, so to speak. We have to have an official vote for the record.
One more,
Yeah,
I can
please.
add a comment. I thought we were just talking about the 5% international versus domestic when we started. With regard to real estate, I think we need to be cognizant of the fact that if we keep printing money, the dollar erodes, even though we don't see it. And I think where you see it is if you look at gold, which has kind of outperformed S&P 500 over the last 2 decades. I'm not saying buy gold. What I'm saying is what we are not seeing is the hidden effects of the printing. So we should be, and the point being, we should be a little bit careful about not necessarily reducing real estate, but reducing real assets, which
Yes.
real estate is a component of it. Surprisingly, we don't have another component of real assets in this portfolio. which I, even mentioned a year ago, could be something like commodities. And I kind of disagree that commodities is it can be speculative, but there are some funds that are more core funds. And over some periods of time, commodities have outperformed, as have international markets outperformed the US market. We have not been in that. And the thing is that we've not seen anything but the US really perform in the last 20 years. So our memories our experiences and memories have been set to expect that tomorrow. And that's the point of diversification, right? So that we are in other asset classes. So what am I saying? I'm saying if we decrease real assets, I think we should have a real estate. We should have a further investigation into other real assets and specific funds. We should have that conversation as to where that 5% can go before we commit to, I'm not against private equity, and maybe some of the large cap money should go to private equity, but, or whatever on the equity side. But before we make that real asset or real estate decrease decision, I think we should have a further conversation with other investment choices to keep the real asset percentage the same while real estate going down.
Sure, a major concern for you is the volume of printed money, isn't it?
Absolutely.
But do you think that, would it be prudent to wait a year or two to see what kind of effect Doge would have on that printing volume? Is that?
Who knows? I mean, we've gone on this long, we can go on for another 5
But I
years.
mean, who knows exactly?
Yeah,
But
yeah. So
it
this is
could
what I'm
be-
saying.
There could be a radical change in
So-
how that
so-
money, and how much money is printed. A year or
Absolutely.
two from now.
So absolutely. So here's, let's take both scenarios. We stop printing. So we printed 20 trillion approximately every decade for the last 2 decades. Let's round it off. So 2 scenarios. We stop printing, in which case, God help us, right? God help us if we stop printing. So because this is not a situation that unwinds itself. It only goes on if you keep going on at an accelerated pace. That means we print even more tomorrow and more after that. It doesn't matter who's in charge. So that's the most likely scenario. So in which case, we have this nominal illusion of return that we are seeing here, right? Or the other side is, like you're saying, we step back from the accelerator, and what happens if we print even more, which is probably what we'll have to do, at least short term. We don't see another way out. So either case, if we take the foot off the accelerator, then we are in trouble, right? And if we put the foot on the accelerator, then we see what we are seeing, which is the erosion of buying power, as we are already seeing.
Is
So
this
the
a
question is,
consensus among the world's great economists, or have we entered a whole nother sphere here of beyond what we're tasked with doing here as a pension board? I mean, is what Sharik's saying what economists generally believe to be a truism across the board, or is there debate about this whole printed money phenomena, or what? I mean,
It is certain we cannot continue to operate at the deficit level, annual deficit level that we're going, because eventually the overall debt of the country would just crush us.
so then,
Now, we don't know how we're gonna get any place, any other direction right now.
And I think
There are
what,
decent plans in government in doing it. But I'm at the point, going back to Sharik's comment, I want us to adopt 10% for real estate. Now, that 5% in the meantime is gonna go into liquid equities, right? If we can come back and convince ourselves that we ought to invest in other areas of real assets, we can always shave some of the money that we've temporarily, in this particular case, put into liquid equities. So we can decide whether or not the real asset component should be 10% or 12 or 15
Mhm.
as we discover ways where it could be, that money could be productively employed. But for right now, I'm just of the mind, we just keep it at 10%, recognizing we have to have some flexibility. That is gonna take us a while. I think it'd take us a
I mean,
while
also
to-
keep in mind that as the replacement cost of real estate goes up, which it is because construction cost is going up and everything is going up.
Yeah.
You can have a indirect benefit to your real estate portfolio because the valuations of those buildings, whether they are 50% vacancy or whatever, still go up.
Well, at least the replacement cost goes up.
Well, I mean, that's valuation.
Fine,
So we have an income component valuation versus, a replacement.
but we're
cost.
right now at about 12% anyway.
Mhm.
Okay, so we're not at 10. We can't get to 10 tomorrow because you can't call somebody up and say, I want 2 percentage points.
Yeah.
Because it will happen as it happens. So what I would propose is that we adopt 10% at this particular point, look for opportunities in the real assets universe that really make very strong, compelling sense for us. And then if they do, then we increase that
That would be
10%
up
for
to-
something else.
ACG to bring us some within your
Yeah,
universe.
Let's just go back to commodity, because as we talked about, many of the opportunities in real assets are in
Private.
closed-end private market funds.
Yeah.
Commodities, definitely not. And if I indicated that we were speculative,
Infrastructure, an infrastructure fund as example.
right, there are some open-ended structure funds. But our challenge with, at least in our experience, working with very large institutional investors that have a board process, governance process, where you're allocating to third-party managers based on an asset allocation, that commodities, primarily through commodity futures strategies, you're not gonna own the hard asset, you're not buying gold and storing it somewhere here in the building. You're investing in commodities futures funds.
No, 1 second. Again, there are, I'm not saying buy gold funds, but they're not all future based. That's incorrect. There are funds that store it in locker boxes in London or whatever, and they are audited twice a month. So there are fund GDX being one of the big, I'm not saying buy that. But that comment that is all future based is not correct. But most of the agri commodities, yes.
Managed funds, the volatility of the asset class is so high that it's what we have seen is it's very difficult for strategic pension fund investors to stick with it. So we had a number of our pension funds that wanted to get into commodities-based strategies in 2008, 2009. They did. By 2015, all the board members that wanted to do that were gone. Commodities were down every year. What are we doing in commodities? Get out. We want to get in. It just presents some challenges. So because from a capital market standpoint, strategic allocation, we go back to the expected return. Our expected return is basically inflation, which was
So then what is the thought on real estate from your side?
real estate.
In terms of the environment we are and your forecasted returns, in terms of decreasing, increasing, what is ACG's view on real estate for a portfolio like this? In terms of it being 13 now,
It's targeted 15, we're underweight.
we are underweight. So what you're saying is ACG's view is in terms of real estate, if anything, and real assets and real estate, we should be looking to increase, is what you're saying?
No, we're not saying that. We're,
Okay,
from a strategic asset allocation standpoint, real estate provides a premium return to bonds with less volatility than equities over time. Our capital market assumption today versus last year is up a little bit because valuations are depressed, and that's for the next 10 years. Just on the ground, what our expectations are for current real estate investments, we think the next several years returns should be better. And what we're hearing from talking to managers, expectations are better. As we look at the overall portfolio mix for an investor that needs a 7.25% return, having a little bit more equities is going to help that. So our position is what we said on page 14, is
Yep.
second column, which is the targets are slightly different, but that allocation is about where you are today. If you want to tactically move around that, we're not opining on that at this point. We typically don't do that. We use rebalancing to take chips off the table and things that have run up. But if you want, you have the ability within your policy to tactically,
Go to 12.
So-
right, or to tactically underweight large cap and overweight.
I was talking about real estate.
Right.
We have the ability to, if we were actually at 10,
But that,
we have the ability to go to 12 or to go to 8.
right, but that's a different discussion.
That's right. You were talking about tactical moving around. That's what I was just giving an example.
So let's point out, what is in this on page 14, you have a 20-year real estate number and the standard deviation, correct?
Page 14.
Yeah. Talking about the 20 years.
Look at 20 years or 10 years.
Portfolios, yeah.
10 years and 20 years. So 10 years, we are looking on a real estate return.
That's not, this is the portfolio on page 14.
Oh, sorry, I'm looking at the wrong portfolio mixes. Real return, where are your real estate returns, 10 and 20?
We're not
I
sure, we're
understand
not
that.
put our long-term assumptions.
Or
in
the
here.
manager.
Has the.
Or the manager we're using? Do we have that number?
The managers, we
Yeah,
have a
We
manager.
can have it indirectly from there. I mean, it's not a index, but
We have, so if you flip to page 42, we have our managers.
Wait, we looked at, I think they answered. No, go ahead, please.
The 10-year return for Reef is 562. The 10-year return for Heitman is 516. We don't have Frista because you haven't had them for 10 years.
you haven't had 20.
Their 5-year return is 6.5.
But if you look on page 8, core real estate and value added real estate at the bottom two of the rows, your projection for the next 10 years, as I understand it, is 6.5 and 7.9.
Correct.
Correct.
I think that was your question.
I mean, I just don't want to prolong this anymore, except saying that I think, I mean, I'm more biased towards real assets. So given what's happening.
Mhm.
So with the lack of a substitute that is acceptable by all, that makes sense in this situation, I would take pause till, you decrease real estate till we find a substitute. And I don't know if stock market at these valuations would be the substitute. My 2 cents.
Well, as a practical matter, we're about at 12. And we're not in control of how quickly we can get to 10. And so I think if we have a target of 10 and 60-40 on equities as an example, we can proceed on that basis. Once we receive those other, we can add an additional real assets sector later on when we have the money. Or when we find something compelling. Right now, we haven't done enough work on it to understand what might be compelling.
I mean, I think, Shriek brings up a lot of good points. A lot of it comes back to the US. Other countries have printed a tremendous amount of money over the last few years. This has really supported the economies because it gives all these consumers, all of a sudden they have more dollars in their pocket and they're spending more, and so stock prices are going up. But ultimately, over time, the more dollars you have cheapens what the actual dollar is worth. And so where a lot of areas where Shariq has brought up that really holds its value in time, I mean, that's what inflation is, right? It holds its value during times of inflation, are these real physical assets that there's a finite amount of them. And so having them, we think, continues to be very important. We still want, at least a target of 10% in our portfolio. Over long term in this kind of strategic world, we do think equities will be able to add some return over that.
Excuse me, maybe I didn't make my point clear. 10% is fine. We're not there yet. We'll get there. We have to separately identify other asset classes in real assets that might be compelling.
So I think what they're saying is it may be a struggle in a pension plan like this to have other asset classes within the real asset universe is what I'm hearing.
Or it may be executed through a private equity strategy.
I don't
Some
know,
of these are.
what I'm hearing is that for a pension plan like this, that may be a struggle. If it's a struggle,
A little bit, I
What we
mean,
have seen is commodities allocations.
so if it's a struggle, then I would take pause in reducing real estate. That's what I said is my 2 cents, so. Because
I understand your point. Well, do we, again, we need to bring this to a close, or should we have a vote on whether or not we're gonna leave the real assets of real estate specifically, allocation of 15 or target allocation of 15 or 10? Or can we move to the overall strategy, the overall portfolio strategy, and have a vote on that?
I say let's vote on that,
On the portfolio strategy you're talking about?
dropping from 15 to 10.
Oh, okay. All right, all those in favor?
But again, we're talking about policy, so we have
Yeah.
to put this somewhere. We can't just say we're dropping from 15
Yeah,
to 10.
I understand it.
our strategic policy, so what we've kind of brought, I got, is our recommendations, page 14, changing our strategic target and our investment policy from the current target that's on the left to that 60-40 column.
Page what?
14.
14.
No, so it's on that page, one back to
Okay.
8.
So
That's
we can
increasing
move.
emerging markets, increasing international small cap, increasing international developed, increasing small cap and increasing large cap. So it's spreading that out in the target.
Sorry.
The actual movement of money, we're not talking about any actual movement of money at this point in time.
Well, the real question is, should we remain a target or move to 60-40? Because I heard more people feeling comfortable with 60-40 than 65-35. Is that correct?
Well, the target is still 15% real estate on that page 14.
Just so the,
On this page, on page 14, the target, current target is 15. Then we have the 60-40.
Mhm.
right, so the current target, the breakdown within equity currently is 59-41. So very similar to 60-40, but that's 1% different.
Mhm.
I'm open to suggestions. How would you like to proceed? We have to bring this part
Yeah.
to a vote.
Okay, I move that for the target, we move 5% out of real estate into equity, retaining the 60-40 split as illustrated in the spreadsheet,
Second column.
the second column
On page 14.
on page
I
14.
would second that.
Any other discussion? All those in favor?
Oh, Bill,
Yeah.
if I could just offer, is there, are we, is this a must vote today, or is this, I'm just, here's what I'm thinking. If there really are lingering questions and there's not peace of mind with everyone, could we, are there follow-up questions that could be answered over the next couple of weeks and we actually hold this official vote at the next meeting? Or is there a reason that we need to do it today? And
I
if
don't know.
everyone's ready, I'm fine with that. I'm not trying to delay. I'm just trying to be thoughtful around compelling action versus just this is a huge decision. This is probably the biggest decision the board needs to make, is setting long-term asset allocation targets. So if there needs to be a little bit more discussion, we could even ask ACG to come back and even provide even more detail specifically around the second column if need be, and then we can hold the vote at the next meeting. If that's unnecessary, then we can proceed. I don't want to slow us up.
Fellow board members?
I'd be comfortable with that.
Comfortable
So
with
long
what
as that
specifically?
discussion at the next meeting is condensed into
Mhm.
subject at hand and doesn't revisit everything we've discussed again today. I mean,
That's what it would be.
Yeah.
And we've been at this for 3 months a week.
I think maybe just a
3
little
months.
more detail on the second column from ACG.
I would agree
then-
with that only if we can identify what that discussion is. we need to be able to identify what we need to continue to
What more
discuss.
we need to discuss?
Because I don't know what questions are on the table that we don't have answers to.
And we may not have a unanimous decision in any event.
So I think on the international domestic, I think we all pretty much went around and answered that. I think.
We got
is that correct?
everybody's input.
Correct.
We do not all agree. We have everyone's input and we go to a vote on that.
I think everybody was, except you, were to keep it at 60, do not decrease the 5% as I heard, and keep it where it is on the international versus domestic. On the real assets, I think I would be with Tony that I think we need more information from ACG in terms of real asset alternatives that are feasible for a plan like this. Whether they be in the real estate arena or some other arena, whatever that is possible. I think what will also be interesting is in times of higher inflation or a period where equity returns were more, how do you put it? Not quite as strong as they have been in the last 2 decades. What has real estate performance been in those periods? I think would be helpful in the board making that decision.
So I think what we can bring back specifically is various equity indices and specific real asset investments and show you historic returns in different calendar years.
Yeah, adding commodities to these alternative mixes is going to not look good. Well, so, because the.
Well, then we have to look at real estate, other, I mean, whatever else, before we reduce that how do we keep, if it makes sense to keep the real asset allocation. And if it doesn't,
The allocation is actually real estate. We simply call it real assets, but it's real estate. So the real question is, what is our?
well, real estate
allocation
is
of real
just
estate?
one thing.
Excuse me,
Yeah.
the real question is, what is going to be our allocation of real estate? I'd like to move along if we can. And we can take up what, if we want to add another asset class called XYZ later. Whether it's 5%, 2%, or 3%, or whatever it might be.
I think though,
Because we've been at this for 3 or 4 meetings, didn't come to conclusion, is you're out of town and then you were out of town, et cetera.
Mhm.
So I would like to bring this to at least some,
Mhm.
I'd like to bring it to a conclusion.
I think, excuse me, though, to Jason's point, from a policy standpoint, the money has to go somewhere.
Right.
So it begs the question, where is it going to go? If we move it, then it'll just all go to equities or get distributed along the current allocation.
Well,
Mhm.
yeah, money's
I
not.
mean, it's not
I
gonna
mean,
come
This isn't
immediately.
going to impact the current allocation, the actual allocation.
Just the target.
It's just gonna impact what's written on a piece of paper, your investment policy statement.
Mhm.
The actual allocation, everything is gonna be, because there's ranges, everything is still going to be within the ranges around the
Mhm.
modified targets. With on the policy, that 5% reduction to the target to real estate, we're proposing it is being allocated among the other equity asset classes.
Mhm.
Those are all going up, pro rata.
I think we only have 3 classifications. We're looking at reducing real assets, one of them, which only leaves 2 to look at, fixed income or equity. Now, I don't think we want to go higher than 22%. I think that's a good, you have to diversify for your fixed income for short-term considerations. For the long term, where you normally make your yield is in equities.
Mhm.
And that's why I'm thinking that's why we want to move from real estate to equities. And I think we can discuss further how we allocate within there, but in order to move forward, just what we've done there in the 60-40 column as a target, remembering this is just a target. It's not how we're actually allocating our actual funds right now. We're over and under everywhere. And we make those changes organically. Just my thoughts.
What do you think, Tony?
I guess I don't know what I think right now, because I'm hearing a little bit of, if there's not much more to discuss, we could even vote it right now. If some of these open items need 5 or 10 minutes at the next meeting just for a completion type conversation, then we should wait and have that conversation. And I think the only piece that might be useful to see for a final asset allocation is that private equity pacing plan that Jason and Finney described. Maybe just seeing what that looks like in the context of a 10-year asset allocation target might be a useful data point. And to me, that would be one reason to, or that would be a piece of information that we could wait to see before we do the official vote.
Okay.
But I'm not hearing, Milt, I'm sorry, I didn't mean to slow us down. I was just trying to make sure that everyone had peace of mind knowing that this is a big decision.
You don't have to apologize for that at all. We ought to have everybody's best thinking here. I welcome.
Yes. I think maybe since there's some discomfort, we wait and vote at the next meeting.
Oh, that's what the vote is. You move forward. If one person doesn't agree, it's not a big deal. That's what you have a vote for.
Yeah, we can deny. There's actually a motion
Yeah, I
on
mean,
the table. I
it's
don't
not
know if-
gonna be a unanimous vote.
Yeah.
I mean, if 7 people want to go in a certain direction, that's fine.
Yeah,
You want to wait until the next meeting? Is there a consensus to wait till the next meeting to take the final vote? Or is there a consensus to actually adopt or reaffirm this current allocation?
That's
Okay.
your call.
yeah, I think if we want to wait on the vote, we just vote against the current motion because there is a motion on the table. I don't know if it was seconded. It was, okay, so I think we need to vote. We can vote it down if we want to have another vote next meeting. Maggie, is that?
Should be withdrawn.
Or we
Can I withdraw? Unless somebody wants to tell me to withdraw. Okay,
Just withdraw.
okay, then I withdraw my motion.
Before you do, just so we're all, for next meeting, Tony mentioned private equity commitment model. Shariq's also talked about, various specific real asset strategies. I'm trying to get
Feasible for.
feasible, so trying to get a sense what all needs to be done before the vote.
Do infrastructure funds count as what category do those
Real assets.
real assets? Okay. So that at least is potentially a viable alternative to commodities, or it's another real asset class. That was my own.
Infrastructure funds are typically private, however, are they not?
There's some open end, similar to our open end real estate, they're open end until they're not.
Similar to I see what you're saying.
There are
Well,
some
they're-
open-end infrastructure funds that would have like quarterly liquidity. And some are in closed-end private equity.
Basically, they're doing double duty. They're actually private vehicles, but real assets at the same time.
Right.
Same as real estate.
And so again, specific to kind of bringing back, as Sharika brought up, feasible real asset strategies that infrastructure can fall in there. They basically show past historic returns relative to equity indices, what they've done over longer periods of time, what they've done by calendar years. So you can get a sense for
And
Up years,
commodity
down years.
strategies are certainly feasible. There's mutual funds that you could do. And institutional quality funds. What I was saying, I wasn't saying they're not feasible. They become, what, in my experience, working with public pension fund boards, they become challenging because there's windows of time when it is very attractive and long windows of time, like the last 10 years, where it's not. And you have to you're then managing the portfolio as opposed to a strategic allocation to something. Where you're saying, okay, we want to be in, we want to be out. And that's what's challenging, particularly when you have.
But the cycles are very long with the same thing. I mean, we don't know when that cycle starts. I mean, I
Telling you
understand.
that
Yeah.
I've experienced
Well, and in
25 years working with.
All right. Fine, we made a decision, I think, to postpone therefore final decision on the the target asset allocation strategy until the next meeting. That's the decision we've made. Now it's 5 minutes to 11. We have to have we have to be open for public questions and comments. And I'd like to adjourn no later than shortly after 11 today if possible. So we have two other things on the agenda. One, active versus passive, and the other was the manager composition for international large cap. Now, active versus passive, can you address that in about 5 minutes? Or do you think we ought to?
Yes, no, I can't. In the active passive, I
I have to
think,
wait because we can't make changes real quick in any event.
flip to page 24.
Which tab is that on?
That is in tab 2.
And it occurred to me coming down here today, neither Sharif nor Pepper were on the board in January of last year, nor Aaron were on the board in January of last year. So they didn't hear this or see this presentation previously. So it is important.
So what we do, and maybe just actually flip back one to page 23, and this is just for every asset class, we have access to eVestment, which is probably the broadest universe of publicly traded managers of publicly traded asset classes that there's there. That's publicly traded is really the one area you can invest passively. So what we do is we track over time what the different excess returns are versus the benchmark net of fees. So another way to say all that, we download all the returns of all the managers after their management fees. And we compare it to the benchmarks. And at every quarter end, we rank all the managers over the last 3 years. We pull out who was the 25th best, top quartile, who was the median, the 50th, who was the 75th, the kind of bottom performer. And we put that in every quarter. And so you see this ranked going across the time. This is over time. So another way to read this, and I'm specifically looking at SMID Cap Core here, at the very end, as of December 2024, for the last 3 years, the 75th best SMID Core manager underperformed the benchmark by about 1% over the last 3 years. The median SMID Core manager, so just the middle of the road guy, after fees are taken out, outperformed by about 1% on a per year basis. The top quartile was outperformed by a little, maybe call that 3% over the last 3 years. We do this for every asset class. The summary is here on page 24. 24, the next page.
Mm-hmm.
So what you can see is we're only showing median, but the average of the median 3-year over and under performance after all fees are taken out. And so what you can see, US large cap on the left, we've kind of done the stoplight chart for the most part in red. So the average large cap manager over time, net of fees, actually trails. The average, not all of them, the middle of the road guy. And this goes to how, we talk about how efficient the space is. It's hard after fees to add value. As you kind of move down this line, you get into the small SMID cap where we have exposure. You can see again, the average person. So if you throw a dart, just hit the average guy, net of fees over a 3-year period, that's what you get. You see in particular, as you get into some of the SMID cap, especially international, it goes from yellow to green, kind of indicating there's a lot of inefficiency in the marketplaces that actually net of fees, managers are able to add quite a bit of value. The only thing maybe I would say then is page 26. The same thing I just showed you, except instead of just showing median, we show the top quartile and the bottom quartile, that 25th ranked and 75th. So again, these blue dots are the average excess return for each asset class of the median. The dark blue is the bottom quartile. So again, I don't care what asset class you're in, if you continue to pick the underperformers, you are going to perform. But similarly, if you're able to pick the top quartile performers in green, you're able to outperform.
Typically, what you want to see is the median above the horizontal line. That means for the most part, active managers are adding value. In some cases, like core fixed income, at least over the last 20 years, active management, even if you're in the bottom quartile manager, you're almost even with the benchmark. The dispersion of returns is narrow in core fixed income, but active management is, for the most part, adding value, multi-sector. even the 75th percentile multi-sector manager is that, so multi-sector is more like Pioneer that you just hired, a Monday Pioneer, that's a multi-sector manager. In that type of strategy, all managers are outperforming the benchmark. In large cap growth, median manager on average is underperforming. You got to really be top quartile to be doing well. So what this leads us to say is, from an implementation standpoint, we're comfortable being mostly passive in large cap. When we started working with you all, we indicated, we were asked a lot, no numbers, active and passive, and our philosophy generally is to be passive in large cap, unless you have really differentiated managers.
Large cap domestic.
Large cap domestic. And you were 100% active in large cap. Well, you had a manager that was kind of a tracking error, risk controlled manager, but they were still active, they were active in taking some bets. We went to 60% passive portfolio. That's what the board's comfort level was. But really active everywhere else. As a firm, typically, other area where with some clients, mostly are ultra high net worth clients that are taxable muni bonds, we typically do in a passive way. But you can see that borne out in the numbers. But so that's the very short version.
Now, currently in our US large cap asset class, we actually have 60% of that is passive and 40% is active. The 40% is split between 20% to an active US growth manager, large cap growth manager, and 20% to US large cap value manager. But there's 60% of that which is totally passive. That's the strategy we pursued up until now. I personally am comfortable with that. We have to constantly challenge our friends from ACG to make certain that we have the best possible manager for large cap value and for large cap growth. Otherwise, it wouldn't make sense to have that as active rather than passive. And thus far, we've done pretty well. But as I understand your conclusion, and almost all of the other asset class, equity asset classes, let's leave fixed income out of this for a moment. And the other equity asset classes, domestic and international, there is a more compelling argument for active management. And the analysis that you have here supports that argument.
Exactly.
Actually makes the argument, doesn't support it, makes the
Yeah.
argument.
As Jay was saying, this helps us identify the areas where we should spend time identifying strong active managers, because there's a better probability, better chances to be able to add performance net of fees. So certainly, so why we look at it over a 3-year period, listen, obviously, just like everything we've talked about today, and returns are cyclical, and active managers don't always outperform in every single instance. But over the long period of time, we want them to be able to add value net of their fees versus what we can get by invested passive.
And this analysis that you have here on page 26 is really over a 20-year window.
Yes.
We're only 3 years over
20-year window. So this is really a very large, in other words, it's the difference between a Kodak camera and CinemaScope. This is really a very broad view.
Are we having an active versus passive discussion here? But we don't have time.
We can bring it back up next meeting if you'd like. However, this.
I think we are out of time today, right? You said we are out of time today, so I just want to make sure that we're not having an active versus
No,
passive discussion
it
right
was- The
now.
whole idea was to try to respond to the question that you raised on whether or not we should pursue a passive strategy as opposed to an active.
So are we having that discussion or? not?
Well,
Just setting the table for a discussion.
We'll have to have it now,
Okay.
later on. And the other item we'll hold, which was whether or not to move from purely Silchester as our international large cap value manager to Silchester and Causeway combined and the international value. We'll hold that until next meeting as well. All right. Is there any other new business on the part of any member of the board would like to bring up to put on the agenda for the next meeting? By the way, it is typical to have an extended discussion on asset allocation strategy because it is the biggest determinator of your eventual return.
Mhm.
The individual active managers, that's an enhancement. But it's the asset allocation strategy which makes you or breaks you. If you have the wrong asset allocation strategy, really good management might save you, but it typically does not.
Yep.
Okay. No other business? Then we'll move to the section of the agenda to hear from visitors. Any questions? Yeah, is there anyone else on the line other than Marion? Questions or comments?
No questions today.
Okay, Marion, you've heard this all before, of course. Thank you. Marion's been around here longer than I have, and I'm really gray hair. What's left of the hair. All righty, we are not having a closed session today. I asked Maggie prior to this meeting, would we need another closed session to go over proposed changes or modifications, I should say, in our ordinance, which governs the retirement plan? And whether or not we need one, to plan on one for next meeting.
Not at this time.
Okay. Just so that is clear. All right, anything else, or can we move to adjourn the meeting? We have a motion to adjourn. So moved.
Moved, second.
Nobody ever votes against adjournment, no matter how long the meeting is or how short. All those in favor say aye.
I.
Aye. Yes. Paul,
Thanks for your time, guys.
Appreciate it.
that made a motion that you.
Two questions.
Good to see everyone.
Yeah, I mean, this is.
Thanks for making this a lively.
Yeah, no, it's different.